So the looks like we need a few more people to jump back on here. Okay, I think we can go ahead and get started. I'll call the meeting of the Finance and Administration Committee to order, and ask Ms. Hopper to call the roll, please.
Teresa Taylor,
Excused.
Henry Jones,
Here.
Frank Ruffino for Fiona Ma, Frank Ruffino
Frank
for,
a few minutes ago.
Present.
thank you. David Miller,
Here.
Stacy Oliveris,
Here.
Jason Perez,
Here.
Ramon Rubacava.
Here.
Mr. Chair, all is in attendance.
Thank you very much, Ms. Hopper. So we're okay. So our first item is the approval of the November 17th, 2020 Finance and Administration Committee timed agenda. What's the pleasure of the committee?
Move
I move.
approval.
I second.
It was moved by Director Rubacava and second, oh no, who was that?
That was Jones.
Oh, President Jones and seconded by Director Oliveris. So any discussion on the matter? Okay, I'll call for the question. Ms. Hopper, call the roll, please.
Henry Jones,
Aye.
Frank Ruffino for Fiona Ma, David Miller,
Aye.
Frank Ruffino for Fiona Ma,
Yes.
Stacy Oliveris,
Aye.
Jason Perez,
Aye.
Ramon Rubacava.
Aye.
Mr. Chair, I have all ayes. Henry Jones making the motion, Stacy Oliveris seconded.
Thank you, Ms. Hopper. The motion passes. We move on to item 3, the executive report. Call on Mr. Cohen.
Thanks, Mr. Vice Chair. Just one thing to highlight that I think will give a little bit of context when we get to the discussion item on the annual report of our local agencies' risk and finance situation. I was able to, a couple of weeks ago, attend the State Department of Finance's Economic Forecasting Conference. This conference that they hold every year is really their opportunity to vet out what the underlying economic forecast will be for the governor's budget that will be released on January 10th or thereabouts in 2021. And I think the thing that I really took away, which won't be a surprise to anyone listening, is the uncertainty upon which our entire economic situation is resting right now. Things are moving very fast as it relates to COVID and the vaccine, as you heard earlier today. But exactly what pace the state's economy will recover once we sort of turn the corner on the pandemic remains to be seen. And if that's true at the state level, it's even more so at the local level, where different situations and different economics are going to be more important. And that's something the financial office will continue to be watching as we go forward. So with that, I'll turn it back to you, and we can go ahead and work through the agenda.
Okay, that brings us to item 4, the action consent items. Haven't seen anyone asking to pull any of them, so what's the committee's? You want to move to approve all of them? Do we have to do them individually, Mr. Cohen, or can we?
You can go ahead and take them as a single motion.
Okay, we'll take a
Move approval.
single motion.
Move approval.
Moved by President Jones, seconded by Director Perez. Okay, Ms. Hoffler, I don't see any comments or discussion, so let's call the question and take the roll.
Hey, Henry Jones,
Aye.
Frank Ruffino for Fiona Ma,
Aye. And I think Frank's having issues. Oh, there he is.
David Miller,
Aye.
Stacy Oliveris,
Aye.
Jason Perez,
Aye.
Ramon Rubalcaba.
Aye.
Mr. Chair, I have all ayes with Henry Jones making the motion, Jason Perez seconded. Items 4A, 4B, and 4C.
Thank you. The ayes have it. The motion's approved. And so we move to item 5, information consent items. And I'm not seeing any requests to pull any of those. So that brings us to item 6, action agenda items. Starting with 6A, basic financial statements, back to Mr. Cohen and Ms. Nix.
Thanks, Mr. Miller. I'll turn it over to our controller, Michelle Nix, in a moment, but this is an annual action item where we seek the committee's approval of CalPERS's basic financial statements. So with that, let me have Michelle walk you through the content of what we've got going on our finances this past year.
Okay, thank you, Michael. Good afternoon, Mr. Vice Chair and members of the committee. I'm Michelle Nix, CalPERS Controller and team member. Today, I would like to present a few highlights from the basic financial statements for the fiscal year ending June 30th, 2020. These will be incorporated into the CAFR upon your approval. Next slide, please. Okay, basically the PERF had total assets that ended up at 392.5. They were net assets that ended up at 392.5 billion. And the annual money-weighted rate of return was 5%, resulting from positive performance across most globally diversified asset classes. Drivers of the PERF's investment return included strong performances in fixed income. Slide 3, please. The PERF annual rates of return. The investment return is comparable between time-weighted and money-weighted this year again. The time-weighted rate of return was 4.7%, and the money-weighted rate of return was 5% at June 30th, 2020. Next slide. This basically just is a review of the differences between the money-weighted rate of return and the time-weighted rate of return based upon questions that we received last year. The time-weighted rate of return measures the compounded growth rate over the period being measured, while eliminating the distorting effects of inflows and outflows of cash, which would consider when money was added or withdrawn from the fund. However, management fees are removed when calculating the time-weighted rate of return. Another way of saying this is that the time-weighted rate of return is weighted heavier to time. So those transactions that are older would matter more to performance than those transactions that are younger. Time-weighted rate of return reporting is the standard for investment performance. On the other hand, the money-weighted rate of return expresses investment performance net of investment expenses that are adjusted for cash flows and changing amounts invested. Another way of saying this is that the money-weighted rate of return is weighted heavier to money. So those transactions that are larger in value would matter more to performance than those transactions that are smaller in value. The money-weighted rate of return is a GASB requirement. Next slide, please. The PERF net position increased by 19.8 billion or 5.3% from $372.6 billion as of June 30th, 2019 to $392.5 billion as of June 30th, 2020. Over a 10-year period from June 30th, 2011 to June 30th, 2020, the net position increased $150.7 billion or 62.3%. Next slide, please. Additions to the PERF's net position include investment income, employer and member contributions. Investment income is comprised of investment interest income, dividend income, and net appreciation or depreciation of the fair value of investments. Net investment income was $18.5 billion in fiscal year 2019-20 compared to the $23 billion in fiscal year 2018-19 due to a lower investment rate return experience in the current fiscal year. Employer contributions increased by $7.3 billion or 47% due to a large state supplemental payment received in fiscal year 2019-20. Employer contribution rates increased between 0.8% and 4% for state, 1.7% for schools, and between 1.9% and 4.8% on average for public agency miscellaneous and safety plans. Member contributions increased $0.2 billion or 5.1% because of an increase in the total active number of participants or members. Deductions from the PERF are comprised of benefit payments, refunds of contributions to members and beneficiaries, and costs of administering the PERF. Benefit payments are the primary expense of a retirement system. For fiscal year 2019-20, retirement, death, and survivor benefits payments increased $1.6 billion or 6.5%, primarily due to the cost of living increases in the benefit payments and to an increase in the number of retirees and beneficiaries from 712,115 as of June 30th, 2019 to 732,529,000 as of June 30th, 2020. It's a mouthful. Next slide, please. As mentioned in slide 6, investment income is made up of appreciation and depreciation of investments, interest income, and dividend income. As the chart shows, global debt securities had the largest gains towards investment income. Slide 8, please. The unfunded actuarial liability, or the excess of the total actuarial accrued liability over the market value of assets, was $158.4 billion at June 30th, 2019. The increase in unfunded and actuarial liability over the 10-year period is primarily due to an increase in actuarial accrued liability, which increased from $308.3 billion as of June 30th, 2010, which is the actuarial valuation date, to $531.2 billion as of June 30th, 2019. Slide 9. In fiscal year 2019-20, $27.8 billion was received in contributions, while $25.8 billion was paid in benefits. Contributions increased 37.3% from 2018 and 19, primarily due to additional payments made by employers towards unfunded liabilities paid in 2019-20, so this fiscal year, basically. Next slide, please. These financial statements, as well as the CAFR, are a result of many hours of hard work from the FRAS team members who prepared these reports within the normal deadlines despite the challenges that 2020 presented to us. This ends my presentation, but upon approval, these basic financial statements will be included in the CAFR for June 30th, 2020. I'm happy to take any questions that you might have at this time.
Okay, I have a question from President Jones.
Yeah, thank you, Mr. Vice Chair. Just a comment, I guess it's a question and comment. I know that on the first slide you mentioned that the money weighted return was 5%, but most of our stakeholders and our members and our colleagues and other pension funds, they focus on the time weighted, and which was 4.7. But I'm just hoping that when we communicate openly, that we're using, I understand the 5 that's a GASB requirement, but I think we need to be sure we communicate up front that our return was 4.7, because, we take so many hits about what our returns were, and some people use an annual rather than fiscal year. So I think it's important to just keep that on the forefront. So with that, I will move the recommendations, agenda item, 6A.
I have a question from Director Brown as well.
Okay.
You want to get a second first from someone, or you want to ask my question?
Well, we can do it after we have the motion on the floor. You were in the queue before we had the motion, so.
Okay, great. I'll ask my question. It's pretty simple. A couple of months ago, Mr. Cohen and I raised an issue about the board consultant expense being shown in staff salaries. Are we still doing that? And if we are, can I get a breakout of those numbers?
We are still doing that. As we talked about last time, view it as completely appropriate, but we're happy to, as we did last time, get you a breakdown of those expenses in the investment personnel and other expenses category. Absolutely.
Great. And then are we on, okay, so I have a comment on the mid-year budget, but I'll wait on those adjustments. We're not on that one yet. Is that correct?
That's correct. That'll be the next item.
Thanks. Thank you.
Okay, thank you. So back to President Jones. I think you were about to move approval.
Yes, I moved approval.
Okay, do we have a second?
I'll second Mr. Miller. Ramon Rubalcaba.
Mr. Rubalcaba, okay. Seeing no more discussion. Oh, no, I have a Director Middleton for a question.
Okay, thank you, Mr. Vice Chair. I'm looking at page 9 of 9, and we had a substantial increase in contributions in 2019, in the 2019-20 fiscal year. What are the projections for the next few years in terms of employer contributions?
Sure. Let me take a first shot at that, and then Michelle can add on anything. I think the large increase you're seeing is a combination of the planned increases as well as the unplanned sort of discretionary payments. In particular, we're starting to see more local agencies make pension obligation bond contributions, which come in large chunks and can really change the trajectory of the line, as well as the state has made, they made the $6 billion payment in the 2017-2018 year, which has caused the spike you see in that graph, and then they made a smaller payment, but substantial nonetheless in this following, in this last year. So I think overall you would expect the trend line to be steady increases based on the base contributions, but the reality is we don't really know what agencies are going to issue bonds or make other large discretionary payments, and certainly the state budget is another area that has huge uncertainty, and that's generally where you'll see the spikes. Overall, you would tend to see the two lines merging over the very long term over the next several decades, but what you sort of see those large increases is a little bit impossible to forecast.
Certainly. Michael, that makes perfect sense. Do we have a breakout either in this report that I missed or somewhere else where we could separate out the discretionary payments from the scheduled payments?
Sure. Michelle, you want to take that one?
Sure. If there is a breakout, I'll have to figure out what page it's on because I don't know what the pages are off the top of my head. So can I get back with you?
You certainly can, and I'm not surprised to find that you got that data sitting there.
Yeah.
I do have it sitting here, but I don't have it memorized, so I need to figure it
we'll
out.
go ahead and send it out as committee direction that all the board members will be able to see.
Thank you both.
Thank you. I'm seeing no more requests for discussion. I am seeing a comment from Mr. Taranto that will be information in the presentation later today. Okay. So at this point, I'll call for the question, ask Ms. Hopper to take the roll.
Henry Jones.
Aye.
Frank Ruffino for Fiona Ma.
Aye.
David Miller.
Aye.
Stacy Olivares.
Aye.
Jason Perez.
Aye.
Ramon Rubalcaba.
Aye.
Mr. Vice Chair, I have motion made by Henry Jones, Ramon Rubalcaba seconding. All ayes for item 6A.
All right, the ayes have it. The motion is approved. That brings us to item 6B, the 2020 through 2021 mid-year budget revision. Back to you, Mr. Cohen.
Thank you, Mr. Vice Chair. This is another action item, a traditional item that we bring you in November, revisions to the budget you originally adopted in April. This is something I've mentioned several times over the last number of months, that obviously this year's budget has changed quite significantly on an operational standpoint due to the pandemic, and the vast majority of CalPERS team members working remotely. And so we, as I mentioned at the July offsite, we have taken a hard look at those expenses that are essential and those that we felt we could do without. And I'll have Jennifer Harris, our budget director, walk you through those.
Thanks, Michael. Good afternoon, Mr. Vice Chair and members of the committee. Jennifer Harris with CalPERS Financial Office. Agenda item 6B is an action item, and we request your approval today to revise the 2020-21 budget. Also included in this item is a report on final year-end expenses for prior fiscal year 2019-20. Next slide, please. In summary, CalPERS proposes to reduce the 2020-21 budget by $72.3 million. There is a $68.5 million reduction in operating costs and a $3.9 million reduction in external fees. Also included is the elimination of 32 vacant positions, reducing total authorized positions for the first time in several years. In general, the operating cost reductions are driven by the COVID-19 pandemic and include statewide compensation decreases, as well as CalPERS directed reductions to further reduce expenses and achieve savings to limit fiscal impacts to the PERF. The changes you'll see in external fees reflect revised investment strategies, as well as updated health plan enrollment data and pharmacy benefit costs. Next slide, please. This slide displays the total revised mid-year budget, which is included as attachment 1 to this agenda item. The chart reveals the budget category changes as compared to the annual budget approved by the board in April. Overall, there is a 9.9% operating cost reduction, which is driven by reductions in the administrative operating cost budget. There is also a 0.4% reduction in external fees. Next slide, please. Within operating costs, CalPERS proposes a $68.7 million or 12.6% reduction in administrative operating costs. This includes $52.1 million in personal services expenses and a $16.6 million reduction in OE&E. The decrease in the personal services budget includes statewide compensation reductions. That's $33.3 million. Also includes reductions for additional collective bargaining adjustments at $4.3 million. And $14.5 million in reductions based on CalPERS directed analysis of operations and workload, with a focus on protecting its core mission and services to members. CalPERS proposes to eliminate 32 vacant positions, hold additional vacant positions open during the fiscal year, and reduce temporary help and overtime usage beyond the reductions you saw in April. The $16.6 million decrease in OE&E reflects both permanent and one-time CalPERS directed reductions to most line items, including general expenses, printing, postage, travel, training, data processing, and consultant costs. Reductions by line item can be seen on page 5 of the mid-year budget. Next slide, please. CalPERS also proposes adjustments to the investment operating cost budget. Compared to the annual budget, there is a $1.6 million net increase in investment operating costs. This is primarily due to an estimated increase for appraisal fees resulting from renegotiated contracts, as well as an anticipation of an increased number of appraisals that will be required this year. This increase is somewhat offset by decreases in technology consultants, as well as costs for trading and portfolio management systems resulting from delayed projects. Finally, within operating costs, CalPERS proposes a net $1.3 million decrease to its headquarters building budget. This includes operating cost reductions resulting from reduced services and renegotiated contracts, as well as non-operating cost reductions due to delaying non-critical building improvements. Next slide, please. For external fees, CalPERS proposes a net $3.8 million decrease. There is a $6.2 million increase in external investment manager fees for opportunistic strategies for new strategies to leverage market disruptions. There is also a $10 million decrease in third-party administrator fees. As detailed in the mid-year budget, this includes $3.9 million decrease in health plan fees resulting from members migrating to health plans with lower administrative costs. There is also $5.2 million decrease for pharmacy benefit costs. This is a result of the board's September 2020 decision to transition from a traditional spread and rebate-driven contract to a market-leading acquisition-based contract. This is consistent with action consent item that you just approved, number 4B, the semi-annual contracting perspective report, which had the Optum RX contract in there. That finishes my comments on the mid-year budget, but before opening up for questions, I'd like to quickly highlight where we ended the 2019 fiscal year. Next slide, please. As shown here and detailed in attachment 2, the 2019 year-end expenditure report, CalPERS ended the prior fiscal year with $283.9 million in unexpended funds. This was 15% in unexpended funds. This includes $78.7 million in operating costs and $205.2 million in external fees. The underutilization of operating costs is largely driven by position vacancies, as well as operational impacts from the COVID-19 pandemic. In contrast, amounts unspent for external management fees results from CalPERS' decreased reliance on external investment advisors. All budgeted funds remain in the PERF until they're actually expended. Therefore, this $283.9 million unspent remained available for investment. That is the end of the slides. In conclusion, CalPERS recommends you approve the $72.3 million proposed in the reduction proposed in the mid-year budget. This reduction is consistent with salary and benefit decreases that are affecting all state of California employees, and it signals CalPERS' commitment to reducing its costs. Thank you for the opportunity to walk you through this mid-year budget, and we welcome your questions.
Thank you very much, Ms. Harris, for a very comprehensive report. And thanks to everyone, the whole team there for all the fine work that went into these lovely results. So at this point, I have a question from Director Brown.
Thank you, Chair Miller. Ms. Harris, yes, of course, I did get stuck on page 5, the best page, which are the adjustments to administrative operating costs. So that's 6B attachment 1, page 5 of 18, for those of you who want to follow along. And I just had a couple of quick questions. I live for the percentages, and so we had a huge decrease in printing, 76.3%. So what do we expect that to be? Is that like signage, wayfinding signage, or is that just agendas we have for public meetings? I'm just trying to think. It seems like an awful lot of printing for all the online stuff we do.
Thank you for that question. It's a good question. The majority of that decrease we're actually seeing resulting from our decision to send out the 3 perspective reports virtually.
Okay.
In print.
Yeah, I didn't think that would account, all the agendas you guys print and put on the back table in the board meetings would account for that, but I just thought I'd ask. And then I do see a big reduction in travel, also a huge reduction in training. I don't think that's necessarily a good thing, and hopefully we'll be continuing to train our staff maybe through online means. I mean, training is important for the staff, and I hope we are going to work on that, and that's probably more for the CEO. And then there's another huge reduction in something called University Enterprises, Inc. And it's a very small amount, but I don't actually know what that is. A 43.1% reduction. So can you tell me what that is?
Hi, yes. CalPERS, as well as many state agencies, contract with University Enterprises, which is actually an enterprise with Sac State. And that's a contract for which we use student assistance. So we, with our temporary help and our reductions, that was one of the reductions that we're looking at.
Oh, so we have it at the top on temporary help, and then we have it down here with university extensions.
The temporary help is for things like seasonal clerks and retired annuitants. That's the number that you're seeing at the top. But for the student assistance, we actually have a contract, and we put that in OE&E because we don't pay benefits on that. It's just a contract again with Sac State for that service.
Okay, thank you. All right,
sure.
Learn something new every day. Thank you.
Mm-hmm.
Okay, I'm seeing no more clarifying questions, and so at this point, what's the committee's pleasure with regard to a motion?
Okay, I'll move it so someone else will.
Okay, if someone, so we're looking for a motion to approve the mid-year budget revisions that have been presented.
Henry motion and I'll second.
Okay. President Jones motions and Director Perez seconds. I'm seeing no calls for any further discussion, so I'll call for the question and ask Ms. Hopper to take the roll.
Henry Jones.
Aye.
Frank Ruffino for Fiona Ma.
Aye.
David Miller.
Aye.
Stacey Oliveris.
Aye.
Jason Perez.
Aye.
Ramon Rubacava.
Aye.
Mr. Vice Chair, Henry Jones has made the motion. Jason Perez second for agenda item 6B.
Okay, the ayes have it, the motion passes. So we'll move on to action agenda item 6C, the CalPERS Board Election Candidate Nomination Petition Options. And I believe that Mr. Dallas Stone will be presenting that, if I'm not mistaken. Mr. Cohen?
That's correct. I'll turn it over to Mr. Stone.
Thanks, Michael. Good afternoon, Mr. Vice Chair and members of the committee. Dallas Stone, CalPERS team member. At the September Finance and Administration Committee meeting, the committee requested the board election team bring back an action item in November with information on pursuing an emergency regulation to suspend the original signature requirement in the nomination petition process, which would permit potential candidates to submit non-original scanned or faxed copies of nomination petition signatures. I will provide that information along with non-regulatory changes that would reduce potential challenges presented by gathering original signatures during the existing pandemic. CalPERS election regulation section 554.5 currently provides that the nomination of prospective candidates is established by the petition on the nomination petition forms provided by CalPERS. The nomination petition form must be signed by the nominee and by the established number of eligible active or retired members. The minimum number of petition signatures required for candidacy is established by the CalPERS board through the adoption of the notice of election. Historically, the board has established 250 signatures as the minimum number of signatures. Attachment 3 to this agenda item provides the existing regulation section which includes the original signature requirement. The part of the regulation that is relevant to this discussion provides that in no event shall less than 250 valid original signatures be required. The requirement for original signatures requires that the potential candidate must submit wet signatures rather than scanned or faxed copies of signatures. If the committee decides to move forward with an emergency regulation to modify the original signature requirement, this is a regulatory language that will need to be suspended or modified. The process for a proposed emergency regulation to suspend or modify the original signature requirement is an abbreviated version of the general regulatory process. The emergency regulation process would require the board elections team to prepare a regulatory package and come back to the committee for approval. The Office of Administrative Law, or OAL, requires that the regulatory package include the proposed text of the regulation, a finding that there is an emergency, and a description of the specific facts supported by substantial evidence that demonstrate the existence for an emergency and the need for immediate adoption of the proposed regulation. After the board's approval, the package is submitted to the OAL and the public comment period begins, which is 5 calendar days. At the conclusion of the comment period, OAL is required to review the regulatory package and make a decision on the proposed emergency regulation within 10 calendar days. If OAL approves, it files the emergency regulation with the Secretary of State, at which time the regulation becomes effective. At a minimum, the process will likely take about 20 days from the board's approval of the regulatory package. The OAL makes the final determination on whether to approve the proposed emergency regulation before it can be implemented. If approved, the regulation would be in effect for 180 days from the date it is filed with the Secretary of State. The notice of election, which includes the election schedule and nomination procedures, is approved by the CalPERS board in February of 2021. If the committee opts to pursue emergency regulatory changes, then the proposed regulation would need to be effective prior to the approval of the notice of election, which means that the board would need to approve the regulatory package in December 2020 or early January 2021 to allow sufficient time for public comment, OAL approval, and filing with the Secretary of State. For discussion purposes, I wanted to provide information on non-regulatory internal process changes that are available to help mitigate the risks and challenges surrounding in-person gathering of signatures during a pandemic, should they be necessary when we begin the election process next year. One internal process change that could be made is to extend the nomination petition period by adding approximately 2 weeks to the beginning of the period. This change would be implemented at the board's discretion through the adoption of the election schedule and the notice of election. The change would allow additional time for potential candidates to safely gather original signatures should they choose to do so by mail or other means that do not involve person-to-person contact. This change is contingent on our election vendor having the capability to print and mail the notice of election within a shortened time frame. Our elections team believes this is likely doable. Another change that is available is the modification to the nomination petition form to provide a single signature form in addition to the standard multi-signature form. One version would be a single signature nomination petition form, only allowing one signature as seen in the sample provided in attachment 1. The other version would be the standard multi-signature nomination petition form as provided in attachment 2. This is an action item concerning whether to move forward with emergency regulations to modify the signature gathering requirements for the nomination petition process in the 2021 member-at-large board election. I'm happy to answer any questions that you might have at this time. Thank you.
Thank you, Mr. Stone. I'm not seeing any requests to speak from the board. It looks like we have one public comment on item 6C. Oh, no, I do have President Jones and then Director Brown. So President Jones?
Yeah, thank you, Mr. Vice Chair. Just a couple questions. There was a reference made to approving in December, but we don't have a board meeting in December. So what was that reference being made to? And secondly, if it does require action, can it be done in November? Whatever you were referring to that was requiring action in December. That's the first question.
Yeah, Mr. Jones. So what we're trying to state is that if an action is taken today that basically directs our elections team to work with our legal office to develop an emergency regulation package, that regulation package would require the board's approval before we submit it to the Office of Administrative Law. So we would need to have a special meeting with the board to approve that regulation package before submitting it to OAL to start the process.
So you cannot complete that process to be to have it as a November meeting?
This month? We would have to present.
I'm sorry. I'm sorry. We are in November.
We are.
So it would have to be by December. So it can't be a January offsite then.
We could do it very early January, but you know, we're expecting at least 20 days for us to package everything up and submit it and to go through the comment period and OAL approval. And OAL could have additional questions to us with regards to how we're substantiating the case of that there is indeed an emergency. Okay. So, you know, time is of the essence. And if we did it in January, there could be no guarantee that we would have it in place before we would bring to the board in February of 2021 the notice of election for approval to begin the 2021 member-at-large election.
So what I hear you saying that we would need to have a special meeting in December to make sure that the process is complete.
Conservatively, we would like it in December, but at the latest January.
Okay.
Thank you.
Okay. And you know, and if we decide to make these changes, I would be open to a special meeting in December, if that's the concurrence of the committee, finance committee members. And well, no, we would really need a full board because it requires board action. So unless other board members have any concerns about that, to work with the CEO to identify a specific day that works for everyone, if we are going to move forward with this proposal. Okay.
Okay. Thank you, Mr. President. Director Brown.
Thank you. Dallas, I'm wondering if you can just tell me what is the difference between attachment 1 and attachment 2. So attachment 2 has 2 pages and requires all the signatures, and then attachment 1 is just for 1 signature?
Yeah, so in order to make things very simple for all of our members, we thought, you know, if there was a candidate that was interested in maybe sending something out through social media, or somebody wanted to go on our elections webpage on our site and download and sign the petition form, we thought that just providing a single signature form would be easier for them. And basically, the difference between attachment 1 and attachment 2 is attachment 1 is really just an abbreviated version of attachment 2. And attachment 2 typically has 50 pages. It's for folks to take to large gatherings and have signatures. We only provided just a sample of the first 2 pages, just file size and overall simplicity.
Yeah, I see that. The only thing about downloading the form, like I say, if you had it up and someone wanted to download the form and sign and send it back in, it has the last 4 of your candidate social security numbers on there. So you'd have to white that out or something, block that out. I do like the single one. I know when I ran 4 years ago, when I would send out the whole thing with a bunch of pages, they go, how many do I have to get? And I go, oh, fill them. No, but it's nice to have just a place for just one, but you would just send out the first page over and over and over and over and over again is what I would do. So so that's very interesting. I just want to ask the committee that, you know, whatever you do, you make sure that it's safe, not only for the candidates and for the beneficiaries, because remember, this is all members for this next upcoming election. And so since it impacts me, you know, I don't want to say anything, but it sure would be easier just to say, you know, no signatures or 50 signatures. I know that would open up the candidate pool, but I just don't want to make it too difficult. So anyways, that's my comments. Thank you.
Okay, Director Olivares.
Thank you, Mr. Miller. I wanted to follow up on Ms. Brown's comment. I'm concerned about keeping Social Security number safe. There's a lot of information that can be accessed just with 4 digits and a name, as well as an employer. And so I want to know what safeguards we have in place.
What is your question again, Ms. Oliveira? So I apologize.
What safeguards do we have in place to prevent identity theft? On these forms, we're asking for name, signature, last 4 digits of social, and employer. There's a lot of information we can get.
Correct. And our internal team does need that information in order to identify the member that signed the petition form to indeed validate that they are an eligible signee on the petition form. So typically it would be the gathering of the signatures is conducted by the candidate, and then the candidate would submit their package to our board elections coordinator in Sacramento, and then our internal staff would work through the CalPERS system to validate those eligible signatures to confirm that they did meet the 250 signature requirement.
My question was, what safeguards do we have to prevent identity theft? At the moment of collection of signatures to the submission of documents.
Well, I guess my comment would be, Ms. Oliveris, is that we are not actively working with the candidates. They're gathering signatures, so I would assume that the candidate would be, you know, putting safeguards in as they're collecting them, and then they are directly submitted to our board elections coordinator. After that, we have the internal ownership of that data. We confirm that they are eligible to sign it, and then after that, they are stored in a secured area, you know, on CalPERS' campus.
My understanding is that we have a higher level of safeguards internally with member information and retiree information. So correct. I would imagine that we'd be consistent in that process. And I would hope that we can have Matt Jacobs take a look at this too, and then maybe a risk review of this. I wouldn't put the last 4 digits of my social security number on this. So I don't know if there's another way we can go about this, but I would want to make sure that we are protecting members' information and retirees' information at all costs.
Absolutely, and I'm happy to work with our legal team and our information security team with regards to the issue that you stated, Ms. Oliveris, to see if there's another way for us to identify the member and ensure that they're eligible when they sign the nomination petition form.
Thank you. And I'm hoping we can hear back on that soon. I also want to make a comment on emergency regs and OAL. Having gone through that process a few times, it will take a while. So I understand why we might need a board meeting in December. It's a very long process with a lot of back and forth.
Yeah, and Mr. Stone, just to build on Director Olivares' comments, in my personal experience, and I think other people who've been through the process will also attest that a lot of members, while they are happy to sign and endorse you, they will not put those numbers, and their signatures are disqualified. They have a legitimate concern. And so I think at minimum, if that is a requirement, some best practice guidance for candidates and the people helping them get signatures, if they're not just doing it by themselves with a clipboard for the most part, would be very welcome. Yeah, so that's that. I do have Mr. Jones with a question or comment.
Yeah, thank you, Mr. Vice Chair. You know, on the issue, I completely support the need to have the necessary protections for our members, but I don't think this is exposing our members any more than the old process in terms of signature gathering. because the requirement of 250 signatures, I personally probably only witnessed maybe a dozen people actually signing those petitions. So what happens is you get people on your behalf going to different people, having them sign, and then they pass that document on to someone else, and ultimately it comes back to CalPERS with those signatures and the last 4 digits of the Social Security number. So I don't see that this is any more risk than our current practice if we're going to have a form that someone can sign and either email it or give it to someone else to get another signature. So I believe that, you know, whatever processes are in place now for the old method, this is not changing that process for the protection of those members.
Okay, thank you. Director Brown again.
Thank you. Ms. Oliveira's raises a really good point, and I think this is why it's always great to have new blood and a new set of eyes on this process. Like Mr. Miller, I did run into problems with people who didn't want to sign, and yes, like Mr. Jones says, those forms sometimes get passed on to other people, and I don't know who has seen those forms with the Social Security numbers. And yes, you can glean a lot even with the last 4. So I do agree with Ms. Oliveira that we should find another way that doesn't require the last 4 digits of the Social Security, some other identifying information potentially, or I also like one signature on a form. So a lot of times I would just send one out at a time, which is very problematic, but I would seal them, and so there wouldn't be, you know, keep them safe. But I think Ms. Oliver, you raised a very good point, and I think we should try to do something to protect that information. We're being required to get it to run for office, so CalPERS should have protections in place to protect beneficiaries. Thank you.
Okay, it looks like President Jones.
Yeah, thank you, Mr. Chair. Yeah, I too am very concerned about the protection of our members. And unless there was a way to make a change in our processes within a month so our election process can go forward, I would be amenable to that. But I don't think we could make those changes now to still have an orderly election coming up. So that is something that I would support looking at as we go forward. But to try to make that significant change in with 1 month, we've already indicated that we got to do something by December to be ready for this upcoming election. So I don't think we have the capacity to make those kind of fundamental change. You know, one of the things is some voting processes include issuing everyone a unique identification number. That's a possibility, but you can't accomplish that at this stage for our upcoming election.
Yeah, and Mr. Jones, every member in the system does have a unique identification number other than their Social Security number that was issued through my CalPERS, but they would have to go in and acquire that number or look up that number. But I think what we should do is, understanding that this is an issue that has come forward that the board is concerned about, let's give this to Dallas and his team to go and see what the options are, and we can bring back a full range of options. As Mr. Jones indicated, it's probably difficult to do that for this next election. So let us also think about what other safeguards we can put in place for the current process.
Yeah, point well taken. And if we have anything going forward as emergency reg, the simpler it is, the more likely we will get it addressed in time without it coming back from OAL, because they find they send things back a lot. Even when they're very well considered, you may have to go through a round or two of question and answer with them. So I guess I'll at this point, I see no more requests for discussion, so I'll ask if anyone wants to put forth a motion to go forward with preparing on the issue, I guess, of the electronic signature question, whether there's any inclination to pursue that, which would require regulation change. We have a motion.
Mr. Miller, yeah, this is Ramon Huerta. I will make a motion that we do ask for the Office of Administrative Law to allow us to change from original signatures to a non-original signature.
Is there a second for that?
Second.
Okay, we have a motion and a second. So I'll open it for discussion. And it looks like Director Olivares.
Thank you, Mr. Miller. So if we were to allow electronic signatures, there are other identifiers through various types of software providers, which would ask identifying information about the person signing in terms of their address, their current address, previous addresses, other affiliations, which could be used to cross-reference the CalPERS identification number for that individual.
Yeah, no, I think you're getting at some of the options that quickly came to mind for me as well, is that this process seems a tad bit dated with the fact that you need original signatures or non-original signatures when we have technology that likely could support this and do the validation into my CalPERS and authenticate appropriately. So let us gather some options and we can bring those back to you after we've had a chance to really do some more research.
Great, thank you.
Thank you. Yeah, and I've got Director Brown.
One last comment: as we start finding high-tech ways to solve this problem, remember that the majority of people who participate in these elections are retired and older, set in their ways, and some aren't even on the internet. So let's make sure we still allow for something manual. Thank you.
Okay, I'm seeing no more. Oh, President Jones.
Yeah, thank you, Mr. Vice Chair. Yeah, to Ms. Brown's comment, we're not eliminating the ability for someone to sign a wet signature and send that in. So that still would exist. Is that correct, Mr. Stone?
Again, it's based on your direction, and I was just going to ask you, when we do take action, we have to be very clear on what your direction is, because I will have to go back with the legal office, and we will have to develop, the exact verbiage of that regulatory change that we will be submitting and that you will be voting on to approve. So what I'm hearing so far is that you guys are going to be taking up an option to allow our members or our candidates to submit non-wet signatures. So I'm assuming this is like a photocopy or some type of electronic download of the form that we currently provide, and we would accept that in lieu of the wet signature.
Well, then all that will be returned to us in December so that we could move forward. Is that the plan?
Correct. I just want to make sure that we're very clear on what you want our team and the legal team to draft, because at that point, if we come back to you in December and we did not hit the right mark with regards to what you wanted to see with that emergency regulation, then we'll be a bit behind in terms of our timing to get everything packaged up and submitted appropriately.
Well, I would support Mrs. Brown's notion that we still allow wet signatures for those who don't have access to technology to send those in as they normally do.
Director Olivares.
Thank you, Mr. Miller. To Mr. Stone's point, everything in the emergency reg has to be spelled out completely clearly. It requires a lot of detail. So to that end, there might be questions about how we validate these signatures. What is our process for doing that once the signatures have been collected?
So we do not have a archive of member signatures. We do not compare the signature to a signature that we have on file. What we do is we take the nomination petition form and the information that was provided by the signatory. We review the information that they provided in our MyCalPERS system to validate that they were an eligible voter in that upcoming election. and that petition was signed. And then at that point, that would be an eligible signature to count towards the minimum of the 250.
Can we check for redundancies?
We do check for redundancies. If someone signed multiple times, we would only allow one signature on that form.
Okay, thank you.
Okay, I'm seeing no more requests to speak. And before we call the question, I will, I think I'll be abstaining because it looks like we have a public comment on 6C. So let's hear our public comment before we do any movement toward voting. So, Mr. Fox?
Yes, Mr. Chair, we have Mr. Tim Behrens of California State Retirees on item 6C.
Thank you, Kelly, Chairman Miller, members of the committee. I thought I had a simple solution for you, but now after listening to Dallas's presentation, it doesn't sound quite so simple. CSR is going through a 3-year election process, and the board waived our normal election process because of the pandemic, and all of our members that are running for chapter office or delegate are self-nominated. So there is no contact made by anyone face-to-face. They just fill out the appropriate form, send it in, and they get on the ballot. Having said that, I don't know if that's possible or not. My next thought was that at least reduce from the 250 to say 50 because the process is going to be so difficult to manage by the candidates running for office. And then looking down the road in the long run, since we gave our stakeholders an opportunity to vote over the internet, maybe in the long run we could have the same thing for nominations done through CalPERS website, where all I'd have to do is get on there, open up a portal, fill it out for the candidate I'm supporting, and that would count as a signature. Thank you. Good luck.
If I could just comment on that really quick, you know, there's obviously a menu of options at your disposal with this discussion, and it could be reducing the signatures from 250 to whatever number you would like. It could be completely eliminating the signature gathering requirement, then obviously accepting non-original signatures on the nomination petition form. I know that back in September, Ms. Taylor did ask with regards to Lacera and LaSur's, you know, what they had done, and Lacera did change their process to allow an additional 48 hours after the nomination petition process had closed to submit the original wet signatures. And then the Los Angeles City Employees Retirement System, they brought forth to their board, allowing either additional time to gather require signatures, reducing the number of signatures from 100 to 50, or completely suspending the signature gathering requirement for their elections. And their board did decide on suspending the signature requirement altogether for that one election. So I did at least wanted to bring that to your attention if that's something that you guys would also like to entertain for discussion.
Mr. Miller?
Mr. Rubalcaba, are you raising your hand?
Yes, thank you, Mr. Miller. Thank you, Mr. Stone. Since it is, I just throw it out there. Are people interested in perhaps lowering the requirement for signatures from 250 to a lesser amount? I know it hasn't been discussed, but it is in the, I mean, it is in the ordinance or the regs, and everything in the reg can be amended or suspended. Isn't that what we're looking at? Suspending or modifying? So I don't know the history or anything about that. So
I might comment. This is Jacobs.
Mr. Jacobs, go ahead.
Thank you, Mr. Miller. The more changes that we propose in an emergency reg, the less likely it is that it gets approved by OAL. And they really should be focused, any kind of proposed changes should be focused on what is the emergency that we are trying to address, or what is the urgent action that is necessary? And here, what we've got to date is the idea that because of coronavirus, we've got a more difficult time collecting wet signatures.
Right.
So that might get us through, but if we start adding things that aren't really specific to the urgency or don't have that same urgency, we're going to have more trouble getting that through OAL on an emergency basis.
Okay, Mr. Perez.
I think Stacy was in front of me. Stacy was in front of me.
Thanks, Jason. Thanks, Mr. President. Mr. Miller, this is in response to Mr. Jacobs too. So typically OAL does require that you be narrow in focus, and it has to be in regard to the emergency at hand. And I think due to the still uncertain nature of the coronavirus, I am actually concerned about disease transmission. So in addition to potential identity theft, it's unclear exactly how long the disease will live on paper. And if you're talking about a prospective candidate collecting wet signatures from people and then sending this on through the mail, there's risk there that we don't need to take. So as we define this for OAL, I think it's important to cite that reason as well. Thank you.
Okay, thank you. Director Perez.
Thank you, Dallas, what did the state do for our state elections this last month? This month?
We did reach out to the Secretary of State for comment, and they reported that they had made no changes to the existing process and still required original signatures on petitions per the elections code. And that was us reaching out to them a couple weeks ago.
And how many did they require?
I don't have that number with me offhand, Mr. Perez, but I believe it's in the thousands, not hundreds.
All right, I hate to put all this work and effort into a waiver or for an exception when, I mean, it's not broke. And then maybe look into it long-term to fix it for the next election. But that's just me.
Okay, looks like Director Olivares.
Thank you, Mr. Miller. Sorry, a lot of questions regarding this. What is the benefit to having signatures collected, to having that signature requirement versus just self-nomination, aside from wanting to narrow down the candidate pool?
Well, this is not, because I think, I mean, I'm just speculating now, but I think it's just that you don't want people on there without demonstrating at least some level of support amongst the constituency.
Okay, so it's only to narrow it down so that way you don't have to provide too many choices and people get confused. Okay, thank you.
Okay, I'm not seeing any more requests to speak. So at this point, I will, Mr. Fox, any additional comments from the public?
Mr. Chair, no, there are no more comments on this item.
Okay. At this point, I'll call for the question and ask Ms. Hopper to please call the roll.
Henry Jones.
Aye.
Frank Ruffino for Fiona Ma.
Aye.
David Miller.
Abstaining.
Stacy Olivares.
Aye.
Jason Perez.
No.
Ramon Rubalcaba.
Aye.
Mr. Vice Chair, I have 4 ayes, 1 no by Jason Perez, and 1 abstention from David Miller. Motion made by Ramon Rubalcaba, seconded by Henry Jones.
Okay, the ayes have it. The motion is approved, and we'll go forward. And I thank you, Mr. Stone, for your presentation and the team's work, and thank everyone for the thoughtful discussion. I think certainly in the longer run, we really want to take a look at our election procedures and see if our objectives and our goals for a lot of these procedure elements could be met more effectively and efficiently in other ways. I abstained because, frankly, I believe that having to have wet signatures in the time of a pandemic is not just a public health issue, but it also is an almost insuperable barrier to any potential candidate who does not have institutional support. And as one of those kind of candidates for several runs in the past, I can tell you it would be virtually impossible for me to go around with my clipboard, and you can find 250 people wandering the streets of Sacramento who might be state employees to sign for me in this environment. So I think we've got a lot to think about for the future, but this is our next step forward. Thanks.
Thank you, sir.
So moving along to our next item here is item 7A, information agenda items, and 7A, annual review of funding levels and risk report. So for that, we go to Mr. Taranto.
Good afternoon, Mr. Chair, and thank you. Scott Taranto, Chief Actuary. Today, we're going to be presenting our annual report, the funding levels risk report. This is an opportunity for the actual office to review the system as a whole and present any the findings we have, as well as talk about any risks to the system that we see developing both now or going forward. I'm going to make some just general comments to begin with, and then I'm going to pass it along to Randy Zubek, who will actually provide additional detail and insights into our findings. Overall, this report shows that while the funding position and the risk of falling to low funding levels in the future are improving, risks remain in the system. Required employer contributions are projected to increase over the next few years, and with the economic slowdown due to COVID, this could pose considerable problems for some employers. Actual contribution increases could also exceed expectations if future experience is unfavorable. Also, recent trends in capital market assumptions suggest it may be difficult to achieve a 7% long-term inflation or investment return without taking on additional risk into the portfolio. During 2021, we will be reviewing the asset allocation and the discount rate during the asset liability management process, or ALM as we call it. If this process leads to a reduction in the discount rate, additional increases to employer and PERF member contributions will be required. Careful review and consideration of risk measures and risk tolerance during the ALM process will be critical for optimal portfolio selection, as well as near-term funding for the system going forward. And with those opening comments, I'm going to pass along to Randy, who will step through our presentation.
Thank you, Scott. And good afternoon, Mr. Vice Chair and committee members. I am Randy Zubek, CalPERS actuarial team. Before I get into the details of our presentation today, I want to make a couple opening comments. First of all, the report that we're going to talk about and the presentation slides today are going to cover pretty much the entire PERF, so all of the plans within the PERF combined. However, there are a couple small plans that are not part of our results, and they are the terminated agency pool, as well as the 1959 survivor benefit program. And the reason I mention that is that I noticed in Michelle Nix's slides earlier today, her results do include those two small plans. And so in a couple instances, my numbers will be off from hers just a little bit. And secondly, we refer to this as an annual report, and for the most part, it is an annual report. However, during years in which we're going to go through the formal asset liability management process, which we will do next year, we typically don't release this report in that year because the information included in this report is going to be provided throughout the ALM process anyway. So you will not see this report likely next year. Next slide, please. So the main topics we're going to cover today are first, current results of the system. Then we'll talk about some potential impacts of the pandemic that we're in the midst of currently, and then finish up with some important risk drivers. Next slide. Okay, so slide 3 shows funded status of the system. So for the entire PERF as well as the significant sub-employee groups. And these funded status results are shown as of June 30, 2018, as well as June 30, 2019. And you can see there was a very slight improvement in most categories from those two measurement dates, with the PERF funded status as of June 30, 2019 being 70.1%. And this is one number I noticed in Michelle's slide was 70.2. That is what will show up in the CAFR. That number includes the TAP and the 59 survivor plan. The reason that we don't have results here as of June 30, 2020 is that even though we know what the asset values are as of that date, the liability portion of this calculation is not yet known. We will compute those plan liabilities as part of our annual valuation process, which we're in the midst of currently. The important thing to keep in mind with funded status is first of all, there's no line that divides a good funded status or a bad funded status. It's important to understand whether, no matter what your funded status is, whether employers are able to make future contribution requirements. And also it's important to just look at the trend of funded status over the recent past. If, for example, you go back over 5-10 years and what you see is a steady decline in funded status, well, that probably indicates that you should at least review your funding policies. In CalPERS case, if you went back over the last 10 years, what you'd see is the funded status hovers right around 70% throughout that period, some years higher, some years lower. So on the one hand, you might think, well, perhaps we should have had some steady improvement over the last 10 years. But on the other hand, we have to keep in mind that during that 10-year period, we did reduce the discount rate from 7.5% to 7%. We also built in improved mortality rates for our members. And both of these changes had significant impacts to the determined liabilities of the system. So even with adding those changes to our assumptions, we were able to maintain our funded status. So I would say all in all, that's a fairly positive result. Next slide, please. Moving on to contribution rates, what we show on this slide are average contribution rates for our different employee groups. And these are rates determined as of both June 30, 2018, as well as June 30, 2019. There is a lag between the valuation date and when the contributions are actually due. So for example, the rates that you would see as of the June 30, 2019 valuation date actually apply to the 2020-2021 fiscal year for state and schools and the 2021-22 fiscal year for public agencies. And what these rates represent, first of all, these are contribution dollars divided by payroll, so expressed as a percentage of pay. And they are the sum of the employer's share of normal costs for the year, plus any required payment towards any unfunded liability that may exist. And it's important to note here that in most of our plans, and so in most of these cases, the UAL payment is actually higher, and in some cases considerably higher than the employer normal cost. And what we can infer from that is that if we were theoretically 100% funded across the board in our system, these contribution rates would be less than half of the rates that you're seeing here, and in some cases, much less than half. Next slide, please. Now, these contribution rates have increased somewhat over the last few years, and we are projecting them to continue to increase somewhat. And this is primarily a result of the decrease in the discount rate and the fact that the impact of that in terms of employer contributions is phased in over a period of time. And so even though the 7% discount rate went into effect in the past, we still are phasing in the impact of that change. And as you can see, after a few years of slight increases, we do expect a lot of these contribution rates to start coming down. And that is for two reasons. First of all, as we get more and more PEPRA members into the system, their costs are typically lower than classic members. And also over time, we expect employers will pay off some of their unfunded liabilities, and so their total contribution will reduce because of that. Now, even though we reflected the 4.7% return here for the year ending June 30, 2020, for future years, we are assuming that the fund earns 7% every year. And of course, if we earn something greater or less, these results could be significantly different. Next slide. So the required amount that employers need to make to CalPERS and to any retirement system around the country typically are based on some type of funding policy that the system has. And in our case, we do have funding policies adopted by the board. And in situations where the funding policy derives a required payment towards unfunded liability that is less than the interest on the existing unfunded liability, we call that negative amortization. And that's because if that contribution is made by the end of the year, we actually expect the unfunded liability to grow rather than decrease, because the required payment towards the unfunded liability is not enough to cover even the interest growth on the beginning balance. But the good news is what we can see from this particular slide is that we've seen a dramatic decrease in the number of our plans, and these are public agency plans only, for which negative amortization is a part of their contribution. You can see the vast majority now are making contributions at least as large as the interest on the UAL, and in most cases more than that even. And additionally, the new amortization policy that went into effect in the 2019 valuations, because it has a maximum payoff period of 20 years, should do a better job in mitigating negative amortization going forward. And the last thing I want to say about this issue is that in the 2019 public agency reports, we added some information in the reports this year that point out very clearly if the required contribution is less than interest on the unfunded liability. We wanted employers to be aware of that, point that out, and also give them an amount that they could contribute on top of their regular required contribution if they wanted to avoid this negative amortization. Next slide, please. And speaking of additional discretionary payments, this chart shows how these amounts have been increasing over the last several years. And again, these are amounts that, first of all, this is just for public agencies. The state is not included in this particular chart. So these are amounts that public agencies have given to us voluntarily above the amount that we require in the actuarial report, in large part because they're understanding more the benefits of paying down their unfunded liabilities faster. It does save quite a bit of money in the long run. And if you look at the prior fiscal year, we had a very large jump in additional discretionary payments. And again, this is just public agencies. We received over $2.6 billion of additional contributions during the last fiscal year. And I think Michael Cohen mentioned this earlier, a lot of that came out of pension obligation bonds being issued by some of our agencies, and then taking the proceeds and giving them to us to pay down their unfunded liability. Next slide, please. So over the next couple slides, I want to talk a little bit about the pandemic that we're in the middle of and potential impacts on the retirement system. In California alone, at the time this was published anyway, there were over 16,000 COVID-related deaths. I believe it's over 18,000 as of today. And we know from listening to our employers and stakeholders that their revenues have been significantly impacted in many cases, making it that much more difficult for them to make their required CalPERS contribution. And we have seen specific impacts in various areas from the pandemic with respect to investment returns, mortality, retirements, and so on. However, it's really too early to tell. We don't have enough data at this point to know if these impacts will result in any meaningful changes to required employer contributions, or whether these impacts will continue beyond a year or so. There is a potential that some of these could continue, beyond the next year or two. We just don't know. Next slide, please. So we know that the investment return for the last fiscal year was 4.7%. As most of you probably remember, earlier in 2020, we were running at a negative return for the year. And luckily, we had a pretty significant rebound towards the end of the fiscal year to hit that 4.7% return. So that is lower than our expected return of 7%, but better than we were expecting a few months earlier. We have seen some data that certainly indicates we're seeing more deaths than expected. Retirements is an interesting topic. What we've seen so far is that in some cases, in some groups, we're seeing more retirements than expected, and in other groups, we're seeing less retirements than expected. And you can see why the pandemic might push someone in either direction. Perhaps they weren't planning to retire, but they don't like working from home. They're afraid of eventually having to go back to the office and getting the virus. And so they say, I'm just going to retire. I'm sure we all know a few people who have done that. Or perhaps they're ready to retire, but they're very concerned about the economy, about their financial situation, and they feel like I better hold on to this job and this paycheck. So at this point, we really don't expect that these impacts on experience will result in significant increases or decreases to the employer contributions. And at this point, we have no reason to believe that they'll continue beyond a year or two, but there still are some unknowns with regard to this pandemic. We do know also that because of the impact on revenues, this continues to be our largest concern for the system, is employers' ability to continue making their required contributions. Next slide, please. So before I dive into some of the risk drivers, I just want to mention that, traditionally when you think of the financial health of a retirement plan or the sustainability outlook, most people start by looking at the current funded status of the system. And we did that on the first slide of the presentation. And years ago, it was not uncommon that that's all you would look at. The actuaries and the boards and folks would sort of focus on that number as if it told the whole story. And of course, we've learned valuable lessons over the past, that there are many measures to look at, many risk drivers, risk measures, projections, stochastic modeling. You need to look at all of these to really get a clear picture of the financial health of the system. So let's start here with a projection of funded status for the PERF, as well as employer contribution rates over the next 10 years. So the left chart shows the projected funded status of the PERF over the next 10 years, given assumed average returns of between 6 and 8% per year over this 10-year period. So of course, our expected return is 7%, and so the line right through the middle represents what we expect to happen over this 10-year period. In any 1 year, we know we're probably not going to hit 7%, but over a 10-year period, there's a good chance that our average return will be somewhere between the 6 and 8% that we're showing here. But what you can see is after 10 years, we can get a fairly large range in funded status, whether we average 6%, 7%, or 8%. And then moving to the right-hand side of the page, these represent two sample plans, public agencies within CalPERS, and show a 10-year projection of their employer contribution rates, again, given the 6 to 8 of average returns, with the blue line in the middle, again, being the expected return. Now, these are sample plans. Every plan that we would look at, if we plotted their specific 10-year projection, would look a little bit different than these. But in terms of the impact of investment return on our plans' required contributions, these would be representative of pretty much all plans within CalPERS. Next slide. So slide 11 is very similar to slide 10 that we just looked at. We're looking at projected funded status on the left for the PERF, projected employer contributions on the right. But our scenario now for investment return is one really good or one really bad investment year for us in year one, and then 7% thereafter. And the range that we're using here, it's very small and hard to read, but I believe it goes from a low of about negative 16% and a high of about 30% between those dashed lines on the chart on the right. Sorry, the left. And these are not likely returns in any one year. However, they are not out of the realm of possibility. In fact, a return of higher than 30% or lower than minus 16%, we have about a 5% chance of seeing that in any particular year. So it is important to know if we receive one of these abnormal years, what will that do to our funded status? And this chart illustrates there's an immediate and significant change in the funded status of the system after 1 year of such an abnormal return. And then if we look across to the projected contribution rates, the good news here is that our 5-year ramp up, which is part of our amortization policy, will smooth the impact of this odd investment year over a 5-year period. So you can see the changes in contribution rates are not as significant in the early years as the changes we would see in the funded status. And the thinking being that typically when we have an abnormal year, like what we're looking at here, in the next couple of years, there might be some kind of a correction in the opposite direction. And so the fact that the employer contribution rates will take 5 years to fully reflect this abnormal investment return gives us time for an offsetting return in the next couple of years. So hopefully we'll never experience the full extent of the impact of this negative return. Next slide, please. So one of the things that we measure annually with our stochastic modeling is the likelihood of falling below a given funded status. We're looking at 40%, 50%, and 60% here. Again, there's no magic line to, what's good, what's bad, what funded status, if we fall below, would we not be able to recover from? There is no such single funded status. But it's very clear that if the funded status of the system falls to a low enough level, it can be very difficult to dig out of that and get back to 100% funded. And so it is important to have some safeguards in place and continue to monitor the likelihood of falling below some of these very low funded percentages. The good news is it's very unlikely that we would fall underneath 50% funded over the next 30 years. However, because of the volatility of the market, falling under 60%, there is some chance of that, some reasonable chance of that over the next 30 years. Next slide. So an important maturity measure that we look at for the retirement system is something we call the asset volatility ratio. And it's simply the ratio of the market value of assets of the plan to the payroll of the active members. And the reason we look at this ratio is that it's a good indicator of the likely contribution volatility going forward. In other words, the higher this ratio becomes, the more likely the employer will see larger volatility in their contribution requirements going forward. And the fact that these have been increasing, which we see from this chart, and are projected to increase further, is really just because of the maturing of the system. This is what tends to happen in any retirement system. As our ratios of actives to retirees change and our asset levels grow and liability levels grow, this ratio just tends to grow over time. So it's not a bad indicator that it's growing. It's just an indicator for all of us to expect some increase in contribution volatility going forward. The safety plans tend to have a higher ratio than miscellaneous plans because their benefits are a little bit more valuable generally. And if we had gone further out in the future, beyond 2020, because of the existence of PEPRA, at some point, once the PEPRA members represent the majority of the system and the majority of the liabilities, we'll see these asset volatility ratio patterns level off and even decline a little bit way into the future. Next slide, please. So, of course, in talking to our employer partners and stakeholders, we know that for many, their required CalPERS contribution is presenting some budget issues for them. We can see here the average contribution requirement for safety plans is over 50% of payroll. And we do expect, as we said, some small increases to these requirements going forward before we think they'll begin to decline. And probably as a combined result of the pandemic and historically low interest rates, we've seen employers use some techniques for managing their employer contributions more so than we've seen in the past. And those include pension obligation bonds, golden handshakes, and furloughs. Now, if an employer were to get into a situation where they were completely financially unable to make their CalPERS contribution, there are policies within the amortization policy that, if approved by CalPERS, could allow a spreading out of the amortization of unfunded liability, which would bring their near-term contributions down and hopefully get them through this period. However, we only want to use that in worst-case situations. It does result in higher costs going forward. If we lower the costs now, they're just going to be that much bigger in the future. Next slide, please. So here quickly, we talked about contribution volatility previously, and this chart just shows you the likelihood of plans experiencing a certain increase in their employer contribution over the next 30 years. And this is within one particular year. So from one year to the next, their contribution goes up by, and we're showing 3%, 5%, and 7%. For miscellaneous plans, and 5%, 7%, and 9% for safety plans. And what you can see, again, sort of based on the maturity measure that we looked at previously, is in most cases, these have risen just a little bit from last year and probably will continue to in the near future as the system continues to mature. Next slide, please. And finally, Scott mentioned this in his opening, we'll be going through the full asset liability management process next year. The board will review investment policies, asset allocation, and make decisions about asset allocation and the discount rate assumption going forward. Over the last several years, just looking at trends in capital market assumptions, we have seen a slight reduction in capital market assumptions over the last 4 years. That doesn't mean necessarily that there will be a decrease in the discount rate. And of course, the board's decision with regard to asset allocation will impact whether the discount rate will need to change or can stay at 7. But given the recent trends and the fact that this is coming up next year, I think it's important as part of this type of analysis to just identify that it is a real possibility that the discount rate will need to be lowered or that the board will choose to lower it. And given employers' difficulty currently for making required contributions, this would just add to that difficulty for many of them. So with that, Scott and I are happy to take any questions you might have.
Okay, thank you very much for your presentation. Very much appreciated and very helpful. I have several questions queued up here, and we'll start with Director Middleton.
All right. Thank you, Mr. Vice Chair, and Mr. Zubek, Mr. Toronto, thank you for an excellent report. I do have a few questions. I'm going to start with just a quick comment. I love understatement. Not all of my colleagues on city councils do. But when I read the sentence, however, employer contribution levels are climbing, and this is potentially increasing financial stress on some employers. Thank you for that smile. Well, actually, it's not the word most of my colleagues are using right now.
Yes, I would say many of our employers would word that more strongly. Agreed.
Thank you. Could you turn to the last chart that you showed on page 15 of 17 of your example? I'd like to make sure I truly understand what you're saying on this particular chart and understand what the difference is between the 3, 5, and 7% of payroll, the 5, 7, and 9% payroll for public safety.
Sure. So what we're showing here is the probability over the next 30 years of any of these groups having an increase to their employer contribution rate of greater than the thresholds at the top of the chart. So the 3% of payroll, 5%, and 7% are really just thresholds that we selected to show you various probabilities. So for example, for the state miscellaneous plan, based on the current results, they have a 55% chance of having at least one time over the next 30 years, a 3% of payroll or greater increase to their contribution rate in a single year. And likewise, if you move across, percentages go down. They have only a 14% chance of getting a single year increase of 5%, and so on. And the thresholds are higher for safety, mostly because they're already at higher rates, and so they're more likely to have a somewhat larger increase given the same event as a miscellaneous plan would have.
And this is in any 1 year?
That's correct.
Okay, so that's helpful. And what one of the things that we know is that the risks vary from employer to employer. So this kind of information, I think, somewhat helps. One of the difficulties we have is trying to define what employers are at greater risk than other employers. And I'm looking for some data that would help us to be able to go to the employer community and give them a better sense of what their risk level is. And so most employers keep coming back simply to that funded status. And I was very much in agreement with something you said right at the very beginning. What's your trend line on funded status? What's your ability to pay in upcoming years? And do we have data that would help each individual employer understand where they're at on those measures?
That's a good question. Of course, every employer gets a unique actuarial valuation every year that provides them their specific information on funded status and projections. Something that is required in the state of California for CalPERS is that all of our agencies are required to make their minimum contribution every year. And if they don't, or if they can't, that could lead to termination of their contract with CalPERS. And so we don't have a situation, perhaps as in other systems, where required contributions aren't being made for some period of time. That tends to get plans in the biggest amount of trouble when they're not making the required contributions. So as of this time, all of our employers are caught up with required contributions. There isn't as much of a range in funded status as you might think because of that. Now, some are better off because they've made additional discretionary payments. Right. And so their funded status is higher, their unfunded liability is lower. their contribution requirements are lower. That's all due to having made higher contributions than what we ask of them. But of course, that does increase the volatility of future contributions. They now have more assets at stake, at some risk in the market. So they have to be aware of that as well. Other than that, I think, based on the funding policies that we have in place, if an employer is able to make their required contributions, and that's a big if, but if they are, they will eventually become 100% funded, more than likely, and we will always have enough money to pay out required benefit payments. Really, the only thing that can really cause us severe problems is when the contribution requirements get to a certain level and a particular employer just can't afford to make them. And of course, the affordability aspect varies widely across our agencies. Some are struggling now, some are not as much and actually have extra money that they can give to us. I will say that the California State Auditor is going to be updating their, I think they call it a high-risk dashboard, where they evaluate the financial strength of the cities around California, and part of that analysis involves CalPERS results. This is their analysis. This is not CalPERS actuarial office, but they rank the cities from 1 to 400 and something based on financial strength. Scott, do you have anything to add?
I'm reasonably familiar with that report, and it has some advantages, and then there's some data in there that I think's problematic. But that's one person's opinion. I'm sorry I stepped on Scott.
Oh, no, that's okay. I was going to say, Randy said on the state auditor's report, that's one tool that's there that some agencies can use to kind of measure their risk. But to what Randy was talking about, I think one of the challenges is we have such a wide variety of employers, and the challenge is finding, what's a meaningful measure, and that varies from employer to employer. Some employers can't handle a 1% increase in contributions. Some of them, it's not a problem. So, the challenge for us is coming up with a standard measure. We've looked at, funded status, we've added additional projections, we've added risk measures. We add a lot of sensitivity to kind of show the employers what's the volatility with the system, what's potential cost increases with the system. And, I think, they have a lot of information. They can call the actuary to have a discussion with them. And I think they need to kind of look at how much their pension costs are in relation to their budget, and how has that changed over time? Because, I think that's one indication, since we don't have the budget numbers. That's not something we can do, but I think that's something that the cities and agencies should be doing, is saying how those costs are trending over time, and if it's increasing, is it increasing at a rate that's going to make it difficult for them to deal with going forward.
I want to be very complimentary, because I think the level of knowledge on the part of the employer community has really picked up in the last few years. And that's complementary to both the employers and to CalPERS in terms of the quality of the conversation improving. But without outing any particular employer, we do have some demographic data regarding those employers that have struggled to make payments, and being able to communicate some of those demographics to the broader whole, I think would be helpful in gaining some satisfaction. I will again encourage the continued conversation with League of California Cities, the chief financial officers, city managers, and mayors and city councils, because the more we're conversing with them, the better they understand the situations we've got going forward. So with that, I'll quiet and let some other folks ask some questions. Thank you.
Okay, thank you, Director Milton. And next we have Director Rubalcaba.
Yes, thank you for the presentation. And I really enjoyed the dialogue with Ms. Trustee Milton, who's also City Council member. So that gives it a whole interesting perspective. And that's what I want to talk about at the employer contribution rates and the pressure on employers to pay their required contribution. I want to start with attached, I guess it's page 617, negative amortization. It's good that it's decreasing, but I actually am surprised that there's still a negative amortization. Because is that because it takes a while for it to filter down? Because I remember when I first came on the board, my first vote was to do the third part of all these funding policy changes, and it was going from 30 years amortization to 20. And I always thought that going to decreasing from 30 to 20 years would actually get rid of negative amortization. So if people are still making their, and I guess state law requires that they make their what's required actuarially, that every employer make their contribution, how can we still have negative amortization? Which means you're not even really paying interest if nothing else. So how can that be?
Yeah,
am
great.
I missing something?
Great question. So these employers, in fact, they are making their required contribution. The issue is that what we determine as the required contribution has a UAL payment that is less than interest on their unfunded liability. And you're correct in stating that the new amortization policy, with its 20-year maximum period, will mitigate negative amortization going forward. But that policy only applies to newly created unfunded liability. So things that happened after June 30, 2019, I guess, or 2018. So all of those existing unfunded liability bases that were established years ago are still being amortized under the old policy, which allowed up to a 30-year amortization period. And for such a long period, and with the method of amortization, the payments for several years initially are less than interest on the unfunded liability. Over time, they increase more rapidly and do pay off the unfunded liability. But that is one of the reasons that we proposed and that you adopted the new policy. So we just need to wait for those old bases to be paid off under the old policy.
Thank you. And we can go to the previous chart, I guess page 5 of 17, and it shows the projected increase in employer contribution. I mean, clearly because of the pandemic and the impact on revenue, on tax revenue, employers have even more pressure than before on their employer contribution. But if that chart was separated by, because you mentioned unfunded liability, I'm sorry, UAL and versus normal costs, would normal costs be more or less level, and the increase is because of their past liabilities? Would that be correct?
Yes. So the levels that you're seeing here, for example, the California Highway Patrol in 2021 was, the number's really small, but it looks like about 59%. That's a combination of the normal cost and the UAL payment. The employer normal cost piece of that is less than half of that number. So, so the reason that these rates are all as high as they are is because we're 70% funded for the most part, and employers are having to make fairly large payments toward their unfunded liability. We're increasing primarily because of the phase-in of the impact of the discount rate change from 7.5 to 7. And once we get to the end of that in the next 2 or 3 years, you know, the hope would be, and the projections would be, that the rates will begin to come down somewhat. And of course, that is very dependent on whether the discount rate changes, which would, result in changes to all of these charts if that were to happen.
Thank you. I don't want to sound like I'm not insensitive, but I know that employers do have pressures, financial pressures, and they have competing demands and everything. But I'm trying to understand what's a realistic picture. Trustee Jason mentions there was an article yesterday or 2 days ago in the Orange County Press about employers having pressures issuing to make their pension, and some people, and I didn't read it completely, but I just skimmed it, and they mentioned some small employers, mostly special districts, that supposedly in a couple of years their contribution is going to double or something, or even more so, and that's hard to believe. So I'm not sure if they're confusing the rate with the total cost, and if they're small enough, I can see how that would happen. But those special districts tend not to have the rich safety plans with the high UAL or high contributions. So did you get how would you explain that article? Have you had a chance to see it? Or I don't want to undermine that, belittle that there is real pressure, especially in this pandemic situation. But I want to make sure we understand what's real, because we're going to, I think one thing CalPERS has to do is we have to defend defined benefit plans, and we need to make sure they're sustainable. And that's why funding policy is very important. But we also have to make sure we understand what's a true picture out there. So if you could speak to that article. And
yeah, great question. And luckily, the reporter reached out to us for some information. So I am familiar with the article. And I think the cost that was being referred to was the contribution towards the unfunded liability. It wasn't the total contribution. And in some extreme cases, when we looked at it, based on getting questions from this reporter, an example of one that was likely to have this big increase was an agency that made a large discretionary payment to bring their unfunded liability way down several years ago. And so they currently have a relatively small, very small required UAL payment because they paid off a big chunk of it a few years ago. And so what they will see based on changes, for example, to the 7% discount rate, is that they are going to see as a percentage large increases in their UAL payment because they're starting from a very small amount, right? And so when we come along then and change the discount rate and add to their UAL payment, it appears that it's growing, and it is growing much more rapidly than the average plan, because they're starting from a very small, almost 0 point for them because of the additional discretionary payment. You're seeing on this slide averages across the system. They're not increasing typically at the rates that were referred to in that article. And the ones that were mentioned were special cases that seem to have reasonable answers.
So they were like extreme cases then, I guess.
That's right. That's right.
Just trying to understand the funding policy a little bit. You mentioned how one of the mitigating factors will be PEPRA, and how the PEPRA employees are less expensive than, say, the classic legacy employees. I'm trying to understand how the other demographics come into play. I know that in 37 counties, this every 3 years they do an experience study, and the demographic is a big factor. How mortality and all that. We did that, but how often is that done, and do you see that really impacting? Because I guess you did speak to it, the number of retirees, number of projected retirements, whether it changes or not, what will impact the funded status and impacts the costs going forward. So if you could just speak. I think maybe I'm getting a little too off the the risk thing here, but just to understand, how does the experience study weigh in on the CalPERS plans?
Sure. We do a formal experience study every 4 years. We're going to do it next year in conjunction with the asset liability management process. We will look at all the assumptions you mentioned, mortality, retirements. The good news, I think, is that in most experience areas, our assumptions come out very close to what actually unfolds with actual experience. We have a very large data set, and so just looking at past results and understanding how things are changing in the world, we can usually get pretty close to predicting a lot of that experience going forward. Mortality used to be one that every time we looked at it, it had improved since the last study, right? And so we would put in a new table and it would increase rates. But the good news with that assumption is that several years ago, we actually built in expected future improvements to mortality rates that we had not built in previously. So not only do our mortality rates reflect the current state of mortality, but also assumed improvements going forward. So again, even with mortality, we don't expect when we do an experience study that we'll see that our results were very far off. The biggest factor is going to be the discount rate. Should that be required to come down for whatever reason, that can have a major impact on cost, because the costs come from the members, the employers, and investment return. And if we believe we're going to be losing investment return, it has to be made up from employers and members. So that will be the biggest factor in determining whether costs will change significantly.
Thank you very much. Really, really, thank you.
Okay, thank you. Looks like next we have Director Ortega.
Thank you, Mr. Chair. Thank you for a great presentation, very clear, and I really appreciate it. I wanted to return to the slide that is called maturity measures. Could you talk a little more about the factors that go into the information that we see here? I understand the point about the volatility or the richer benefit on the safety plans driving sort of their higher position on the graph, but is there any of the number of employees who are coming in to, like newer employees coming in to sort of start contributing to the system? Is that part of what we see on that chart as part of the maturity factor, aging plan factor?
Yeah, I don't know if we can, there we go. So the lines represent the ratio of the market value of these plans to the active payroll. And maybe one plan has a ratio of 10, just to toss out an example. That just means their assets are 10 times greater than their payroll. And the 10 by itself doesn't really mean anything. There's not, again, a line of, over this is bad and under this is good. It's just sort of a numerical indication of how volatile your future contributions may be going forward. And so as the system continues to build up assets, obviously we have $400 billion or so of assets, and it just keeps growing. And of course, all of that money is exposed to the market and the volatility of the market. So when an individual plan builds up a significant amount of assets, that's good. That's what we want to happen. But it does mean that they could experience a certain percentage increase in their contribution rate going forward more easily or more likely than if they had a lower amount of assets. And so, yes, current members are always leaving and they're being replaced by newer members. But for now, the market value of all the plans is continuing to grow. And so this measure is continuing to grow. But yes, when the PEPR members become the majority of the plan, because their benefits cost less, we won't need to build up the same level of assets. And these lines will dip down a little bit beyond what we're showing here, ending at 2025. So I hope that answered your question.
That helps. I think it helps me to refine my question a little bit. So is there an element of so as it relates to the payroll factor in this graph, do we see any, or would we be able to find out if there's any factor of payroll declining because not as many staff are being hired, or not at the same rate as they would have been? I'm asking this question because one of the things that that you might hear when people talk about pensions is as the percentage of payroll grows for some of these classifications, it's essentially costing you 1.5 times, right, for one person. So does that have an impact on that department's ability to hire? So, for a police department, does that factor into their ability to hire new employees because they're paying this higher cost on the pension side? And does then a shrinking payroll factor into this maturity measure?
That's a great question, and I'm not sure how well I'll answer it, but I'm going to give it a try. It's a bit of a dilemma to look at required contributions as a percentage of payroll in the first place. We do it here for simplicity, but as you may know, in our valuations, we separate the UAL payment from the normal cost, and we show the UAL payment as a dollar amount. We've just, for simplicity, added it to the normal cost and converted it to a percentage of pay, because people are used to looking at contributions as a percentage of payroll. They're comfortable with that presentation. But yes, we run into difficulties when we have a plan that for some reason the payroll is experiencing some abnormal growth or decline. We have plans that, for example, maybe a safety plan that had both police and fire, and they decide they want to have their fire protection contracted out outside of their plan. And so now their fire people all become inactive, and their payroll is now just a police payroll. So they still have a very large plan with the benefits for those fire members, but now their contribution looks really high as a percentage of payroll because they had a really sharp, unexpected decline in their payroll. So the fact that the payroll goes up or down doesn't impact the dollar amount of the volatility of the contribution as much as when it's expressed as a percentage of payroll. And again, it does cause confusion. Some of our reports will show that we have some agencies who are making 70% or higher percent of payroll contributions. And again, when we drill down and look at them, there was this kind of unexpected decline in payroll for a variety of reasons. Does that help?
Yeah, thank you.
Okay.
Okay. Thank you very much, Mr. Zubek, and very illuminating again, and great discussion and very helpful and beneficial answers and responses. So I've got a public comment on number 7A, and so I have no more questions or comments from the board members, so I will go to public comment. Mr. Fox, do we have our commenter?
Yes, sir, Mr. Chair. We have Mr. Bijan Mariar from the League of California Cities.
Thank you, Mr. Fox. Can you all hear me?
Yes, sir. Go ahead.
So, board members, thank you very much for the lively discussion on this agenda item. As some of you may recall, at last year's meeting when this item was brought up, I was accompanied by 5 or 6 city managers from a diverse array of Northern California cities who spoke to the challenges that they all faced in meeting their CalPERS obligations, despite at that time being in the middle of an economic expansion. And they talked about the challenges of balancing the need not just to provide critical services to their communities, but also in terms of hiring and retention and the ability to give raises because of the demands of their CalPERS obligations. And what we think that you all should take away from this report is that the support for employers, the ability to make sure that they can keep making their employer contributions, is really the lens that you should apply when you go through the ALM process, when you're making decisions about the asset allocation and the discount rate is really asking and having the educated discussion about what the impact to employer contributions will be. Furthermore, 2 points that I want to make is that on the PEPRA front, while we can appreciate in the long term that bringing on PEPRA members may lower the obligations in the out years, the fact is that many employers are either furloughing or laying off staff and won't be able to rehire and reap the benefits of that PEPRA membership because of the impacts of the pandemic-induced recession. And secondly, with regard to the state auditor's dashboard, we strongly would caution you at using that report to make any judgments about the ability of cities to meet their obligations or their financial management, because that report, for example, penalized cities in their financial ranking if they had low reserves, regardless of the fact that perhaps the reserves were low because they were using that money to make ADPs or to set up a 115 trust so that they could further support their CalPERS obligations. And so as always, the League of Cities is always there to work with you, to support you, and to be a partner in any of the endeavors necessary to make sure that we have an affordable and sustainable pension system. Thank you very much.
Thank you. I do not believe we have any more public comments, do we, Mr. Fox?
Not on this item, Mr. Chair. We do have one under the public comment 7C.
Okay. Okay, so I believe that wraps up this item, and we go to, let's see, I've lost the screen here, so committee direction.
Yes, sir.
Direction, Mr. Collins.
Yes, I've got 3 items. First is the breakdown of the investment, personal and other administrative expense item that we've provided for you in the past. We'll do that again. Second was the discretionary payments. I think you saw that on slide 7 of Randy's presentation. I also wanted to point you to page 68 of the financial statements, attachment 1 from that item. I will leave it to Board Member Middleton if she wants to reach out for additional information. We're obviously happy to pull that together. And then the third item was further work on protecting privacy information, social security numbers in particular, as it relates to the election item, both in the short term as well as the long term. We will bring you back additional information as appropriate on that one.
Okay, sounds right to me. I see no questions or comments, so we'll move to item 7C, public comments. Mr. Fox.
Yes, Mr. Chair, we do have one caller on item 7C. We're having some difficulty on the screening, so stand by for just a moment. Standing by.
Hello, can you hear me? Hello?
Yes, go ahead.
Yes, ma'am.
Hello, how are you? My name is Serena. I am contacting the Finance and Administration Committee today because I am a right-of-way acquisition agent for the City of Tulsa Engineering Department in Tulsa, Oklahoma. And I'm reaching out in hopes of possibly getting the correct contact information for the person or group who can authorize a payment from the City of Tulsa to the retirement system in the amount of $32,527 for a utility easement on property that is owned by CalPERS. An existing stormwater pipe needs to be replaced in the parking lot of 2 retail businesses who lease retail space in a building that exists on property you own in Tulsa, Oklahoma. I have reached out to your property manager that is on file with the local tax assessor office. However, I have not received a response from them in about 9 weeks. The easement requested is for 3,097 feet CalPERS would remain owner of the entire property. I'm just looking for contact information if someone can help me.
Okay, thank you, ma'am. I will see if I can direct staff to follow up with the caller and see, what's going on. Does that sound reasonable, Mr. Cohen?
Yeah, Mr. Miller, if the public commenter can just remain on the line, we can have Mr. Fox get her the appropriate contact information.
Great, thank you.
Mm-hmm.
I think that about does it for Finance and Administration Committee for today. So we will adjourn, and I believe Risk and Audit will begin, let's say, at 4 o'clock. Take a short break. Okay, we are adjourned. Thank you all.